Hello everyone. So this is the third lecture in the series of the risk management where we are going to discuss on the credit risks, market risks, liquidity risks or operation risks. So in this video we are going to discuss on the infrastructure and the project finance and how the risk management will involve in the infrastructure and project finance. So here we are going to look on the financial both the strategic capital and risk restructuring. We discuss all these things in detail. So before moving to the next slide, I would like to request you if you are interested in the risk management domain or the infrastructure project or in the AIML domain or the quantitative analyst or the model risk validator role. So please do like and subscribe my channel. So I'll continuously creating videos on this topic and that will help to get the opportunities in these areas. So let's start discussion on the first slide, that is infrastructure lending and the principles of that. So first of all, we are going to discuss on the characteristics of the infrastructure lending, where we discuss on the characteristics of the long tenure financing, high leverage profile, cash flow based underwriting and the construction risks portal. And then also we are going to discuss on the policy and regulatory deficiency and complex and multidisciplinary domain. So in the long tenure financing, we are going to discuss on the maturity, where typically will happen in after the 30 to 52 15 to 30 years. If we know that the infrastructure project like a construction of road or the project or the railways or the ports, so that will take long duration to complete that project, and the recovery of the entire amount is also a long tenure. So such kind of project is long tenure in the year, and to mismatch the long economic life and extend the ramp up period for highway, renewable plants, metros, and the water assets. Then we are going to the second characteristic, which is the high leverage profile. So in a project finance structure, really prominently on debt equity typically account for only 20 to 30% of the capital stake. So it will be high leverage kind of the project. Then we are going to see the characteristics of cash flow based underwriting. So there will happen the repayment depend on the project asset cash flows, not sponsor balance sheet, driven the rigorous analysis and technical feasibility, demand traces and operating assumptions. So it's depend on the cash flow, how will happen and what are the repayments will be happen. That will depend on the cash flow of the project cash flow. And then we are discuss on the construction risks each part. Also large project face a delay, cost overrun despite a supply disruption in the pp and epc setting. Time overrun can cascade into liquidity strain, higher IDC, and convenient negotiation will happen in this page. So that's the characteristics of the fourth. Let's move on the next slide where we discuss on the two characteristics of these. So then the policy and regulatory dependency, evolving framework, tariff, tooling right, annuity structure, environmental norms can maternally shift outcome. Lender assess the consent stability, regulatory history, and enforceability of the governments will happen. Then the complex multidisciplinary domain. So effective lending integrate in engineering, risk management, financial modeling, law, and the public policy to balance the long-term risks. Public sector interplay and stable cash generation will happen for the characteristics of the infrastructure lending. So let's discuss on the project development stages for the infrastructure lending. So there are the four stages or breakdown of the four stages, like a pre-construction or the construction stage, stabilization stage, and the operation stage. So each stage we discuss step by step. So infrastructure projects follow a defined multi-stage development life cycle that influence the risks perception, lender involvement, and financial structuring. The pre-construction stage typically involve a land acquisition, environmental clearance, a right of way permission, project decision finalization, and the negotiation of concession agreement and long-term take-off contract. The phase largely determine the project bank liability, has delay in approval and land despite can uh, drill. So timeline before the physical work begin. Next is the construction stage, which represent the most risk intensive period due to heavy capital outlay, contractor performance uncertainty, and the sustainability of material price influence and uh, geological surprise. So lender at this stage closely monitor the progress through independent engineer milestone based on disbursement and contractual safeguards such as fixed price, EPC agreement and liquidate demand causes. After the construction comes the stabilization stage where the asset begin trial run and commissioning are gradual ramp up and design operational outcome operating acting issue often the surface here, and the lender assess whether the and rely achieve its expected technical and financial benchmark. Once the asset stabilize, its transit into the operation phase where the steady state revenue routine maintenance as a long term performance become a central to operation stage, usually feature a lower risk and demand visibility. Tariff certainty track record become a clear across all stages. The project involve effective lender projection, cash flow pattern, and refinancing opportunity highlighted the importance of stage appropriate structuring, monitoring, contractual enforcement, and improve that things. These are the four stages we are going to break down the project finance, and then we'll discuss on the risk framework in the project finance. So in the risk framework, we are going to discuss on the completion risks, revenue demand risks, regulatory risks, and then we discuss on the counterparty risks, asset liability mismatch risks, and effective evaluation. These kind of risks we are looking in the risk framework in the project finance. So the project finance structure allocate the risks across stakeholder, developer, lender, contractor, and the government authority to ensure the long-term sustainability. Completion risk is one of the most critical form arising from delay, design failure, contract underperformance, contractor underperformance, or unforeseen site-related complications. Any slippage in the construction timeline can increase the project cost, extend financing period, or compress cash flow, requiring lender to emphasize detailed due diligence and robust contingency planning. Re- Revenue and demand risks varies by sector. Toll road project depend heavily on tariff volume, renewable energy asset rely on resource availability such as winds, speed, solar irradiation, and regulatory asset depend on tariff framework. Lender mitigate this through long-term PPAs, minimum tariff guarantee, viable or viability gap funding. Uh, Regulatory risk is counterparty risk emerging from reliance on keys such as EPIC, contractor or QAM or operator and government payment authority. Default or delay payment from these entity can sustain the liquidity. The liquidity liability uh, mismatch. The liquidity liability mismatch is one of the most important risks that arise become infrastructure asset generated long term return where the lender may fund through the shorter tenure liability. Tracing banking systems stability, effective risk evaluation, demand stress testing, contract enforceability analysis, scenario modeling, and comprehensive examination of sector specific uncertainty to ensure the project remain resilient across the economic operation and regulatory shifts. That's we think on that there. Then we are going to move on the next and most important topic, which is the triple P structure and models, where the Triple P stand for the public-private partnership model, where we are going to go toll, put annuity and hybrid annuity HAM, and the model choice we are going to look is this topic. So Triple P model determine how responsibility, risks and reward are shared between the public authority and the private developer. Build, operate, transfer BOT, build, operate, transfer structure are among the most widely used, with various such as BOT tool or the BOT annuity catering to different risk appetites. Under the BOT tool, the concentrationer fully bear the tariff and revenue risks, earning tenure directly from tool collection. These model incentivize the efficiency but expose the primary private party to microeconomic cycle, co- competing routes and unpredictable tariff behavior. So conversely, boot annuity offer a predetermined payment from the government regardless of tariff levels, shifting demand risks to the public sector and enabling long-term revenues stability for lender and developers. Over time challenge in pure boot model leads to emerging hybrid annuity model, where the 40% of project cost is funded by the government during the construction and remaining 60% is paid annuity along with the interest during the operation. So HAM balance risk allocation by reducing upfront financing need, limited tariff exposure, and enhance the bankability. It has been widely adopted in heavy development in India due to improve the predictability, structure, cash flow, and reduce the volatility. Each PPP model influence the project leverage, risk absorption, construction length and the lender comfort. Making model selection is crucial component in structuring viable infrastructure projects. So these are the important things in the PPP model. So let's move on the next and the important thing, where we discuss on the credit enhancement mechanism. So where we discuss on the different kinds of tool that we'll use in the credit enhancement, like DSRA, debt serve account, or the stroke waterfall, sponsor support, takeout financing enable, and the partial full credit guarantee and collectivity. So where we discuss on the credit enhancement, strengthen the credit profile of infrastructure project by reducing risks for lender and improving the predictability for debt servicing. One of the most common tool is the debt service reserve account. So DSRA, which require setting aside several months of debt obligation to act as a liquidity buffer in case of temporary cash flow dispersion. This mechanism is especially critical during early operational year, when stabilization issue may affect the rebate and consistency. ISRO mechanism provide a lender to control over the cash flow and outflow by challenging or changing all project revenue into slightly monitoring account structure, prioritizing allocation for operations, maintenance, debt servicing, and reverse before any distribution to sponsor. Sponsor support undertaking include the equity infusion, guarantee or shortfall funding, guarantee reinforce project resilience by ensuring the promoter absorb initial shock and cost overrun. Takeoff financing arrangement allow long tenure refinancing by specialized institution once the project become operational, addressing the asset liability management challenges faced by a commercial bank. Additionally, credit guarantee, whether from the multilateral agency, development finance institutions, or government backed entity, enhance the credit worthiness by providing partial or fully coverage of debt obligation under the predefined trigger. These institutions like collective instrument collectively improve the lender confidence, facility over borrowing cost, and increase the project ability withstand sector operational and macroeconomics uncertainty. So that's are the credit enhancement tools. So these are the end of this slide, guys. And if you are interested in the more in the corporate finance or the risk management. So please do like and subscribe my channel, so that's motivate me to create and more such videos for you guys. Thank you so much.